Welcome back here with Money. We've been talking about the advisory model of financial advice and pitching it against an execution-only model to try and find out what would work best and for whom. And helping us do that is Anurag Seth of Quant Capital. So Anurag, we've spoken a lot about which model works best and therefore what model should an investor opt for. Where do mutual funds figure? Now, very recently, the SEBI chairman, UK Sinha, had said that, he is hesitant to ask mutual funds to actually cut their commissions further, right? They want to put the onus on the funds themselves to do that. Isn't that counterproductive in some manner? And by when do you expect actually to be some form of regularized functioning over here?
I think SEBI has done already enough or more in terms of your commissions that a distributor gets. So I think the alignment is already in force. If you see the investment advisor regulation is also talking about that direction, because SEBI, as a regulator, wants the client to pay for the advice till the time they are valuing that advice, instead of the entire industry focusing on execution model. And bulk of the issue comes from the issue of mis-selling. So because once you are very commission focused, the client alignment and your alignment are completely different. Because your alignment is how to make more and more commissions on it. Client alignment always would be how to make investment returns, which is higher than a normal inflation adjusted returns. So to that extent, I think there is enough and more effort that have already been taken by SEBI. I think alignment on fees, of what you talked about, is a market-driven phenomena, and it will keep on happening. So it's a continuous process. So at one fine day, no one can say, there is no commissions to be charged, because we are in an industry which is still, I would still call it, there is a lot of financial inclusion still to happen. It's not that entire, so at a percentage of investment that are going into equity, still I think we are at 3 to 4% to maximum at 5%. So I think there's enough and more road ahead, and there's enough and more. It can be a market-driven phenomena, and it will get adjusted and will get absorbed at some point of time. But if you're asking if the market is ready for a no commission structure and a fee-based advisory structure, we have walked the path. I think it's a long way to go, and for clients also to understand, there's nothing comes for free, so it's better. So I'll give you since you talked about mutual funds. So if you do a normal case of example, a 50 lakh kind of investment. So normal management expense on an equity mutual fund is 2.5. So you're anyway paying 1.25 lakhs as to a fund to manage investment for you. Now comes a scenario if you're holding a portfolio of say 2 crores and you pay, so it is for the client to decide whether he wants to give that money for a particular transaction or he wants to give that money on the entire portfolio of what he holds. So I think that helps, that realignment of thought process has to happen.
Okay, I get that. Let me now flip this argument on its head, right? One way of looking at it is, are we ready for a situation where there's no commission to be paid by mutual funds, right? You mentioned that financial inclusion still has a long way to go. While there may be a flux of investment advisors in the mega cities, what about tier 2, tier 3, where there is only, say, the relationship managers who are present, right? If there is no commission that is to be paid, how do these guys actually, how do people in tier 2 or tier 3 cities actually get advice?
See, that is what I was saying at the start of the discussion. So there are certain phases. So like a wealth accumulation phase and wealth generation phase. So for a retail kind of setup, you don't need an advice. So what you need is a right allocation of funds, which I think today's entities in any tier 2 or a advisor is doing a right job in terms of just allocating your funds properly and in a manner where the objective has to be met. The problem comes when the portfolio and the wealth accumulation stage. So generation is one. You have done your, and bulk of thing is first preference always in India remains a real estate, and then becomes debt and then becomes equity. And then is a wealth accumulation stage. That is where you would need an advisor to come in to play a role, whether the existing allocation is right enough for next 10, 20 years. So that is the outlook one needs to have, a long-term outlook while you are engaging with an advisor. There's no point engaging with the advisor with a 1 to 2 year view.
But has mis-selling actually come down to a great extent because of this reduced commission structure?
It will be. Now, whether it has completely stopped,
Could it, in theory?
in theory, no, because it doesn't get driven only by an advisor. So at the times when there is a portfolio review happening, you know, and you have invested into a scheme or a, you know, equity or a direct equity where the portfolio haven't performed. So at times there is always a constant engagement with the client, or if a client investment objective has changed because of certain conditions or because of certain emergency. So obviously that kind of, so I would not term it as a churning, I would term it as a reallocation of portfolio.
But have you seen at least some more participation in direct plans of mutual funds as a result of this?
See, as advisory process starts to gain momentum, what would happen is most advisors will anyway have, because I told you either the client has a option to go to any of the existing, but then he keeps on continuing paying the commissions. So the best way to do on an advisory side is to invest in a direct plan where you save a particular amount of commission that get paid, and then you are anyway paying the advisor based on the performance, and then that can be a part of the advice. So what you are saving as a commission can be a part of your holistic approach towards your meeting your investment objective and paying the client.
So basically de-link the two, pay for advice, and then you know,
save on,
save on the
commission.
All right, Anurag, thanks very much for actually breaking this down for us and making us understand it. Thanks very much, and I hope you have a happy New Year.
Thank you for having me.
All right, on that note, a quick break. Still ahead is our tip of the week.